Well, welcome everyone. Kia ora ana tātou katoa, tēnā koutou katoa. Martini mamano, karapa te whai. Many hands make light work, and I want to thank all of our wise and committed staff for this publication. I have with me today Jeff Bascan, Deputy Governor, and Chris Bloor, who is in charge of all things financial stability reporting. We also have some senior staff members with us. I'm very pleased to be presenting the November 2019 Financial Stability Report, and I think the first thing to say is that financial resilience is in the New Zealand financial system. We like to write this report about the issues that we are looking at, concerned about, and of course how we set our policy course. Financial vulnerabilities do remain elevated, however, and we see plenty of ongoing work that we have to be done by the Reserve Bank and our fellow regulators. International financial system risks are elevated and have risen over the last 6 months. In particular, global growth has slowed amongst ongoing trade and, I suppose, geopolitical uncertainties. Reflecting that, global interest rates have declined, particularly long-term interest rates, and are now at secular low levels. While a low official cash rate, low short-term interest rates are necessary at this point to maintain our inflation and employment objectives, persistent low long-term interest rates globally can lead to other challenges for financial stability, and that's what we talk about. What are those challenges? Low interest rates can encourage excessive debt, can encourage excessive risk-taking, and it can lead to overheated asset prices. So it's in that context we decided to leave our LVR restrictions in place of where they are for high loan-to-value ratio lending. We do remain committed, obviously, to bolstering the robustness of the banking system, and we see strong bank capital buffers as a key component of the resilience of the banking system to enable it to operate efficiently and soundly over the long term. As you know, we will be finalising our decisions, announcing our decisions on bank capital proposals on December 5, so I apologise I won't be able to answer any questions on that today. Over recent quarters, we've also undertaken reviews of the conduct and culture of financial institutions, and including their risk management and assurance processes. We have been experiencing ongoing breaches of key regulatory requirements of banks. And so again, it's in this context that we are engaging more with the industry to strengthen their risk management processes and their assurance processes related to culture, conduct, and the broader risk management within banks and the insurance companies. To do this, we also are bolstering our own supervisory capability and intensity so that we can be, I suppose, provide a much closer scrutiny over these systems. Finally, we note that some life and general insurers have declining solvency buffers. They're still above their regulatory minimum, but that buffer has been declining through time. This comes during a period of that secular low interest rate environment, which can raise the value of their liabilities through time. So we have been talking with the industry, and we will be reviewing the liquidity buffers, solvency buffers I should say, and the insurance regulation with greater intensity over 2020. Of course, we encourage the insurance companies to act now rather than to wait for ongoing regulation. That, fortunately, is it from me for now, and we're open to questions. Thank you.
Hi, Jenny Ruth from Business Desk. You say that you're going to increase your scrutiny of banks and insurance companies. What's been happening to staffing levels on the prudential side of the bank?
Our staffing levels are growing, and we've got plans for further growth as well, and also increasing our people on the ground in Auckland, Tamaki, Makaurau, where a lot of these companies' head offices are as well. So that's all part of our we outlined it in our strategic priorities, and we're underway bolstering now. We are looking to increase, probably we're talking around about 30 plus or so of the core on-the-ground supervisory folk. Is that?
Oh, well, it depends on funding to a degree.
Yeah.
So we've made increases of in the order of 5 or so far, and we're certainly looking to a substantial increase in the coming year and the following year, subject to both internal and funding decisions and discussions with the Treasury and the Minister.
So that's already on board, but also we have got plans for significant increases in numbers. And for those who don't know, but you can hear the violin in the background, this is where we are going back through our funding agreement with our stakeholders for the next 5+ years. Given the challenges and tasks that are in front of us, we will be making a very clear business case for more. I would like to also say that intensity is not just number of feet on the ground. It's also what we're asking as explanations from the banks, from the directors, because our 3 legs, ourself, our market and our regulatory discipline framework remains in place. On the self-discipline area, we're asking for both not just to tell us what you're doing, show us how you did that. And I think the show component is one of the reasons we are seeing a lot more of the regulatory breaches, because it really is challenging banks on their own operational and risk management controls.
So that's at 5 up from 30?
We're currently staffed around 38, I believe, in our supervision function.
Governor, could I ask how close you were to loosening the LVR restrictions?
Not particularly. So it's been a balancing act for us. We are one of the few central banks that has the good fortune to be a full service, both monetary policy and the regulatory supervision, macroprudential. So on the one hand, we have lowered interest rates for the clear purposes of monetary policy, but we've kept the LVR there to ensure that these tail risks, the high loan-to-value risks, don't restart. So we are modestly pleased that we've seen, the house price growth slow to below income growth, but the price to earnings levels still remain high.
So what would have to change to do another loosening?
I think we need to get more confident around bank lending behaviour. So we can look at lots of different indicators around the starting point of risk, and that remains elevated. That's around some of our key asset price to earning ratios. So the starting levels remain elevated, but they are declining slowly through time. We have seen a shift back to some higher house price growth, but it's not about that alone. It's about how are banks managing their higher risk lending behaviour. And what we've seen to date is that they like to fill their boots as quickly as the LVR is eased, they take up the full slack. And so we need to have a much stronger confidence in how that is being managed.
Because I noticed in the report there's a comment that current policy settings are appropriate and will be watching how risk evolves over the coming months. So if you say it's not particularly close to a loosening, does that mean that a loosening in the next coming months or in the next year or two is unlikely?
I would never say unlikely. I mean, why stop optionality? I think the important thing is that once every 6 months on the publication of the Financial Stability Report, we will announce whether we are or are not changing the LVR. And it's probably giving a better sense of this is a long-term financial stability setting rather than a short-term cyclical tool a la the official cash rate.
Governor, you make mention in the discussion on dairy debt that some banks have been increasing their margins, basically at the expense of some of the most indebted dairy farmers. Do you find that acceptable, and how concerned are you still about dairy sector debt?
I'll let the team talk about it. I'll just say something very quickly at the high level. These are commercial decisions by the banks and with the customers. The debt levels that you're observing now have been an outcome of the behaviours of both the borrowers and the lenders over the last 10 years or so. What makes us nervous is sudden changes in behaviour where people are suddenly holding more risk than they ever realised, or fair weather behaviour coming from banks. So that's my opening comment. Re the debt and concerns.
Oh, well, we continue to be concerned about a strong tail of highly indebted farmers. That's very concentrated. And I think the figures, Chris, are still about 20% of farmers having around 45% of the debt. So amortisation is very low for those because they're paying such a high portion of their debts of their income and debt servicing as it is. It makes it hard for them to wind that down. It's a slow process. You'd be realising significant capital loss probably if you tried to sell a lot of that land. So it's going to be a slow haul. As the Governor said, the banks themselves are managing customers on a, pretty much an individualised basis and trying to adjust their pricing and their credit management to the circumstances of those entities. So that's the challenge they've got if they've decided that they're riskier than they thought they were before, or they're not performing as well, or they requiring higher margin for that risk.
Do you find that acceptable?
Well, we're not in the business of competitive assessment of every bank's commercial activity. It's a competitive sector out there. I guess those customers have got to consider their choices, and hopefully the competitive dynamics will be the part that disciplines any behaviour by the banks there. But as you say, as the Governor said, this is years of possibly underpricing to some degree some of that lending risk. When good times looked, like they'd be sustained, we saw credit lending standards getting quite slack in the early 2010s to 2015s, and then they've tightened them substantially since.
What I would love to see is more equity and lots of alternatives of long-term capital provision, whether it be debt or equity, into some of these sectors, particularly the dairy sectors. And so that will be, no doubt, part of a transition. Obviously, our capital proposals are all about enabling banks to be friends in good times and bad as well over the longer term. So these are long-term transition issues. It is interesting. It is very concentrated in the dairy sector. So agricultural non-performing loans have actually, Chris, they've been declining.
Increased slightly recently.
Just increased slightly, but they are at still below historical.
Yep, well below post-crisis highs.
Janae, can we just remind everyone to use the microphone, please, and introduce yourself? Thank you.
Janae Tibshirani from interest.co.nz. I'm just wondering what the likelihood of LVR restrictions actually being tightened might be the next time they are reviewed.
Well, I mean, thank you, Janae, for asking that question. It was kind of a follow-up to Bernard's. It's not sitting on our agenda, but why would you rule out optionality? I mean, these are macro-prudential tools. They are about tail risks, and we need to be focused, they're limited in their capability. I think our single biggest challenge, which I'll just repeat, and I have to say I'm not too sure how we get there, is around confidence around banks' lending behaviour to the higher risk, more exposed parts. So at the moment we know the LVRs are binding, and we'll be watching.
Brian Fallow, New Zealand Herald, I guess. Your figure, I think it's 3.2, would suggest that something like $150 billion worth of bank funding is being raised offshore. Are you comfortable with that level? And is there a risk that it will rise further if monetary policy puts more downward pressure on deposit rates?
I'd say a couple of things. One, far more comfortable than what we were, i.e. banks are far more reliant now on funding from deposit and long-term debt. I mean, an enormous proportion used to be less than 1 year. So I would say those are the two biggest improvements to the banking sector post-GFC, where we have more sticky forms of funding. But without doubt, there remains the fact that the banking sector is dominant in our capital markets, that a few large banks have the real access, the biggest access to this offshore funding, and our, New Zealand's access and cost of that funding will always be an Achilles challenge to the banking sector. It's not unique in New Zealand. This is how banks roll globally, but it's something that we have to watch. And it's something when you have secular low interest rates, it feels comfortable. It can even start to add a bit of a competitive advantage to those banks who have the best access to global funding rather than more reliant on domestic deposits while interest rates are low. So that's, calling it out.
I think that addresses it. It's on our watch in terms of the stability of funding and how much a prolonged low interest rate environment potentially slows deposit growth. We're not seeing significant signs of that at this stage. Deposit growth is still holding up, around 5% thereabouts.
Right.
So, but if we're impacted more by those low rates and they took deposit rates down more, for example, then you could see that balance of funding switch. So it's just on our watch, but not an acute concern at all at this point.
Hi, Laura McDonald from NewsHub. Given the massive focus on banks' conduct and culture lately, how concerned are you about these allegations against Westpac Australia? And can you say whether Westpac New Zealand can expect any extra scrutiny as a result of this?
I'd say the high level, very concerned. We have very clear anti-money laundering and financing of terrorism restrictions laws, and that we take those very seriously, and we are in close engagement with all banks all of the time. It's straightforward in saying, it's complex in the operation of these activities, and laws have been evolving through time, as well as banks, all banks, insurance, all people managing transactions, their sophistication and ability to watch it. The Westpac Australia findings are severe, and I had the good or misfortune of being in Australia at the time when it came out with the senior regulators of the financial institutions in Australia. And as you can see, as the story's evolved, it is something that the public are demanding they really understand, and the regulators are highly involved. We are closely engaged, always have been, with Australian regulators, the relevant bodies involved with the AML, and we've gone out to all banks and said we're watching, provide us additional assurance along with our business as usual, but also with Westpac. We are Westpac New Zealand. We are engaged with them, looking at what the actual issues are that have come out of Australia. I mean, this is over a long period of time. We've had to start cold for this specific issue, but also in more general. So we will be working very closely, or are working very closely with them on this. Should we find anything, we would take our normal course of action, and the public would hear about that in due course. That's where we are at this stage.
Hi, Lynn Greaves, Banking Day and Newsroom. Sort of tangentially on Australian regulators, with the crackdown by APRA and also your proposals over capital, ANZ has talked of a possible restructure so that of its New Zealand operations, so that some customer relations might be handled through ANZ Australia. What's your view on that, and have they actually approached you to talk about this?
We don't talk about individual banks, as you realise, about what they are or aren't engaging with us, but we are also acutely aware of intended and or unintended consequences of any regulation. So we are remaining very close with APRA around what they are proposing, what we have proposed, and we understand very clearly the intersect between the two. In fact, we've been working hand in hand through this bank capital proposal. Jeffrey? Yeah.
Yeah, we have limits on what can, the amount of business that can be written through branch arrangements, which I think is what you're getting at. But banks those who do have branches have some flexibility to consider which part of their business is conducted through the branch versus the incorporated local subsidiary. So it's something we would look at in terms of the compliance with the rules that we have.
Right. And just again, are you concerned at all about a sort of slow retreat by the Australian banks from New Zealand? I mean, there's been quite a bit of jawboning from the Australian banks, so about around that. And what might the banking landscape look like if that happens?
It's hard to predict. One, as you say, it's been talking in advance of any change rather than change itself. We've seen lending growth continue in excess of nominal GDP, so the banking sector is still very comfortable out there. It's still highly profitable. It's still well capitalised. We have had the more recent jawboning, to quote yourself, has actually been in the positive direction. Of course, we are committed. We have been here for X decades, so on and so forth. So that is all very positive. Our challenges at the margin are how they will meet whatever the requirements are and what that means for some specific sectors or not. And as we've already talked about, banks are revisiting the risks of their dairy book. We hear some stories of small to medium-sized enterprise. I think what we as New Zealanders have to remember is, or always remind ourselves of, is that it's the same in every other country as well. It is a very global competitive environment, and the New Zealand banking public desirable for the returns on capital that we provide. So I can't tell you what shades of colours banks will be, but they will always be a big part of this economy. And in fact, at the moment, they dominate this economy in terms of the capital markets.
Hamish Rutherford from the New Zealand Herald. You say you've been continuing to pick up capital breaches. Have your views on those capital breaches evolved? And I just note that you gave your comments around the recent stuff that you picked up about BNZ were much more mild than, for example, what you said about ANZ.
I mean, with every issue, sorry, I was very pleased that you are sure you're with the New Zealand Herald, unlike your colleague over here. Every issue has its own background. And so this is what we have to do. We have to calibrate both. There's a breach or not. Then there's the scale of the breach or not. There's how long or how persistent breaches have been. There's particular different, scalars of the importance of particular breaches. One on a capital might be different to something on an operational risk. So there's the full array of management of those breaches. One thing we are doing is making sure that sunlight being a good disinfectant, people hear about those more, but there is a calibration challenge for us, around what those tools are, or what our actions are. And I would note in our capital proposals, we've proposed a significant buffer on capital, but it doesn't mean that as soon as you go through the top of the buffer, the red card comes out. We are saying we will be calibrating our reactions as we come down, but doing it transparently so that market and self-discipline are still involved. Chris or Jeff, do you want to dig me out of whatever hole I'm in here?
No, I think that's fine. The big message is that we're disappointed that compliance has not been as strong as it should be, and as we have asked banks to undertake stronger assurance processes to review their compliance more thoroughly, they are finding more issues than they thought they had. So we're working through that with them in terms of the thoroughness of their reviews, what root causes there are, and the extent to which they're getting on top of this. So as the Governor said, that does get to be somewhat individualistic in our discussions with them, but the common theme is look harder, dig deeper, and make sure you're compliant.
There are no favourites, but there is certainly calibration around what the issues are.
And just probably a couple more questions on staffing. Are you saying that you won't be effective in your prudential role if you don't get greater funding? And also on the exercise of reconsidering what capital levels banks need, do you believe you have adequate staffing to do things like the cost benefit analysis work that you've said you will undertake?
We are we are highly effective, and in our regulatory behaviour, we can be more effective. So, in large part around saying how do we be more on the ground. So I can't re-paraphrase what you said, but my response is no to the first part. I think it's no. You had a couple of double negatives in there, but we're very comfortable. And around our staff capability, it is very, very high when it comes to policy, when it comes to analysis. I would like to remind people that we had 3 international experts, all totally independent of the bank, totally independent of each other, who all came through with exceptional positive comments about our capital proposals. That doesn't seem to have got the press that some other people have got around our capital proposals, but these are true international experts, and all will be revealed.
Katie Bradford from One News. Just on these banking breaches, do you think, you've been sending this message for some time now, do you feel like the banks are actually listening to you or willing to listen to you and make these changes?
Very much so. Our challenge almost is, the show as well as just tell. Our challenge now is that, in part around our people capability is in terms of breadth of issues is calibrating and managing. So, this is, it's well past the end of the beginning. We are now more normalising where the banking sector is, and I think the public will get more used to hearing or seeing about particular breaches without it being kind of the front page news that some of these have been. Some in the future may well be front page news. It depends on the scale and severity. Yeah.
And just changing topic back onto the housing market, all signs are that it is starting to pick up again. Are you worried about the effect that may have on first home buyers and just in general on the market?
Yeah, we do make comments in there. I mean, we have been very conscious, for example, that our loan-to-value ratio, by far the largest proportion of people outside of this is in the owner-occupier, not the investor, but the larger proportion of people in the high LVR have been first home buyers. I'm pleased to say that growth has continued, so they are still getting access, but they do sit in that high LVR. And so, that is just the nature of what it is. When you start out in life, you don't have the big deposit or the growth in the equity. But it appears that's not choking anything particularly off. But of course, a higher price means a higher hurdle. At the same time, they've got lower servicing costs. At the same time, interest rates may not stay low forever, so on and so forth. So it's about trying to get that balance. And as you can see, I suppose the decision on the LVR wasn't that hard once you go through those ratios. Yeah.
Charlotte Greenfield from Reuters. I think you've touched on this a little bit, but you do say in the statement that we can expect greater scrutiny of financial institutions. So if you could just be as specific as possible about what that looks like. And also, if you could just clarify, is that related to the bank capital requirements or is that a whole separate issue?
It's all one big parcel. Market discipline we've put the financial dashboards out. We're highlighting for the banks, and we're going to be working on the insurance companies for the same dashboard, so that wise people like in this audience can go on there and see exactly what you are buying into around the market discipline. Likewise, around market discipline, we are calling out more often what the breaches are and what we're doing with it, even and with the calibration. The self-discipline really much is around show us how you got the assurance, and that is putting a lot more emphasis on the boards and senior managers to not just say things are fine, show us how you got to that burden of proof. And that comes from work that Jeff and team did back in 2017, where we reviewed the attestation regime, and we found that some banks didn't know what they didn't know. And so that wasn't necessarily a positive assurance, was it? No. And we're saying shift from negative to a positive assurance. And in doing that, that really does put the asset on the banks to have to do it. Then the regulatory discipline, our lot, well, we've talked about higher capital. That's a nice safety for all. We've got increased macro-prudential tools. We're also going through a significant legislative change, which is talked about there, which is around who comes in the net, what tools they are, who gets to decide how and where those tools are calibrated, as well as the people and capital on the ground. Is that specific? By the way, all of this is in our statement of intent as well, so it's not a sudden revelation. It's there around one of several of our key priorities. Several.
Just another question about Westpac. When did the Reserve Bank become aware that AUSTRAC was investigating concerns around AML in Australia?
We have ongoing close contact with many regulators, and so I'd have to say that there are ongoing investigations all of the time. To give you a sense of this, for this specific one, I'm not sure of the exact timing, but their final announcements and decisions are theirs, and we found out literally as the markets closed, etc., around what they're going to do. That's the nature of it. But it is a global, we have to be totally connected. There's Australia, there's the US, there's the Philippines, there's everyone connected, and there are many agencies that need to be connected as well, and internal bank systems. And so it's a complex thing. In we've had what's the parlance? We've got the PTR, the
prescribed transaction report.
Prescribed transactions. They're the
suspicious transactions.
Well, you could tell it. Suspicious transactions.
We have processes of reporting and obviously compliance obligations on these institutions, and there is, as the Governor said, engagement all the time with other international regulators as to what is going on in this unfortunately dark world of money laundering and terrorism financing. So there's a generality of exchange and of information and so forth as to the particulars of the particular charge that or charges that AUSTRAC decided to file. So they informed us of that very close to the public announcement. But we interact on an ongoing basis to exchange information and support each other in our compliance investigations and understanding of how these transactions may or may not be executed.
So there's the suspicious transactions, and people come on and off the list through time, and organisations, etc. And then there are these prescribed transactions, and this is anything over $1,000. That's why the 23 million number. These are high volume, low value transactions happening day in, day out. The world where systems and frameworks need to be popping up and identifying suspicious activities, patterns, so on and so forth. So it's a challenge.
I mean, I just note the comment that you made earlier about the Reserve Bank having to start cold on the issue. And I don't know if you can expand on that, but my interpretation of that is a little bit concerning, perhaps, that there had not been a higher level of engagement on those issues earlier.
I was perhaps, unfortunately, flippant with that comment. So we are hot all of the time, but we found out about what the exact issue was, as the Deputy Governor just described, what the exact charges were while the market was closed. And so for that specific set of charges, literally you have to say, well, what are these specific issues? Other than that, all day, every day, we are engaged with our AML team within the bank and everyone else who's involved both within New Zealand and internationally. So, by the way, there is, as many false positives as there are potential issues coming up, and so it's about working through those. So I apologise if I sounded like the fire station just got woken up. We are there all of the time. This is real life, real time.
Okay, sure. I just have a question about insurance as well. I note that a decent part of the insurance section talks about solvency and some of the concerns, and that partly off the back of the interest rate environment being lower. But how much are you going to focus on solvency in the IPSA review, and what is your message to insurers who might be looking at banks and thinking, oh, we might be in for a similar shake-up?
Yeah, we've given the insurance market a clear signal already. In fact, public, we want to see better buffers on their solvency. So they hear that, then the question will be how long's a piece of string? And that will be part of the review around the IPSA, which is the Insurance Act that we're reviewing. So it's first cab off the rank as part of the IPSA review, but we want to see more, not less, when it comes to solvency buffers.
Yeah, we don't have a quantum in mind. We don't start with a predetermined view about what but we have started with a presumption that having a regime where it's not just a black and white, pass fail, which it sort of currently is. Effectively, you're solvent or you're not, in terms of regulatory standard, doesn't give us as much leverage as or safety as we would like. So the notion that there could be some graduation, a buffer, which means we can intensify our scrutiny and engagement before they fail the regulatory test, has some merits. And that was a recommendation in the Trowbridge-Sultan's report on CBL. It's something we're carrying through into our thinking, but how big that is, what it means, all of that is work to be done a long way ahead.
Wonderful.
I note you use debt-to-income measures as part of your analysis through the report. Do you still have a hankering to have debt-to-income ratios as part of your macro toolkit?
I'd say yes. Quite how that comes on or not, to be determined. But, it's certainly something that sunlight needs to be shone on through time.
Have you put a case to government, a renewed case to government on that?
These types of issues are being talked about within the legislative review that's ongoing, the nature of the tools and who gets to play with which one.
Bernard Hickey from Newsroom Pro. I'm just asking about the number of regulators that you have dedicated to each of the big four banks. You said you had 38 overall. But how many have you got at the moment dedicated to each of the big four banks? I have heard somewhere that it's not many more than one per big four banks. So if that's true, how much would you expect that number to increase?
100%.
So.
Oh, look, we do think we need a substantial increase in our supervisory staffing. We think to fulfil what's being asked of us, the expectations that are running through the phase 2 review of the bank, the IMF said that we needed to increase our resourcing to do the job. They said we were doing well, but needed to be would be benefit from doing it more intensely. More verification, more opportunity to deal and respond to issues as we find them. The expectation is we would have a substantial increase, as the Governor said earlier. So, look, we've got planning numbers, we're having those discussions and we're working through that. We think that will help bolster our scrutiny and ultimately confidence in the compliance and confidence in the financial system.
And just to give you comfort, there's more than one. There are many. There may be a lead person who is the 0800 regulator, but when you think about it across there, we've talked about AML, we've talked about capital, we've talked about macro-prudential tools, we've talked about regulatory requirements and supervision. I meet with the board, the directors, Jeff meets with the CEOs. It's a whole of bank effort. Remember, we also bank the banks, so we see what they're doing around their liquidity flows and their money operations, their capabilities. We are constantly in contact with them through our technology. So we have a very holistic view of the banks because we are a full-service central bank.
In Australia yesterday, the chair of Westpac Group said he wouldn't seek reappointment after the Austrac allegations and the CEO resigned. Do you think that the ANZ chair in New Zealand, who some believe is conflicted because he's also on the ANZ Group board, should take responsibility for ANZ's capital calculations failures and other failures, and also resign or not seek reappointment?
I think they're very different issues, what you're talking about. So, and I would say that everything we've heard from ANZ, New Zealand and their board, they have taken responsibility for the issues that have arisen. Wonderful. So, me taki mā thank you very much, everyone, for being involved. I can't quite say it yet. I was going to say have a good Christmas, but we'll see you December 5, possibly, some of you. Thank you.